Okay, so hello, and I wanted to do a lesson on confirming probabilities. And the reason why I kind of like felt inspired to do a lesson like this was just from our last room today. So today we had NFP release, and that came out around 8:30. Now, we talked about certain probabilities that we're looking for before going in and taking a trade, right? So if we just go back and look at price action at the time where we had our live stream. Now, by the way, our live stream is recorded, will be uploaded to YouTube, so you can go and watch the two live stream clips or recordings before you can come back to this video. Just to understand what we're referencing, because we went a little bit in detail on the live stream about market probabilities. And if you take a look at DXY here, so at the time going into the data release on dollar, we were talking about all the possibilities in DXY, right? So if I just use a replay tool and just cut all the way to when we had that 8:30 a.m. Candle, which is this. So this is 8:30. All right. So if I just use a replay tool just to cut all the subsequent price action after the data release. All right. So initially we wanted to see the data open bearish because all of the hints and everyone's expectation going into non-farm employment chain numbers was that we're going to see negative data. Now, if you go on Forex Factory and you look at the outcome of the economic release, you can see we actually were opposite to the initial expectation. Now, if you go and watch your recording of today's live stream, I was talking about the fact that the data opened, right? And in terms of fundamentals, so when we talk about fundamentals in terms of price action, we're essentially talking about interest rates, we're talking about central bank policy, we're talking about economic data. So we're looking at job numbers, right? Manufacturing sector, manufacturing numbers, inflation, and all of that. So when we have to discuss um, when we have to discuss price action from a fundamental perspective, we're essentially talking about this. The economic calendar is that fundamental perspective. And I can see here that the data actually opened and was bullish in DXY. And I talked about the fact that when we saw that initial spike at non-farm employment numbers, right? A lot of traders would look at the data and say, okay, well, we've seen bullish data on dollar and we've seen price actually spike higher, not understanding that the underlying fundamentals on dollar is actually bearish, like we discussed before, right? So the overall trend so far is a bearish trend, right? So the major question is how can we determine what the trend is? The simple response or the simple answer to that question would be, are we respecting discount arrays and disrespecting premium arrays, or are we respecting premium and disrespecting discount arrays? Right. So that's simply how you can gauge order flow on any time for whatever. So if we just conduct that same mental framework, if we just conduct that same mental framework in this current price action a dollar, right? So what are we respecting? Are we respecting discount arrays or are we respecting premium arrays and disrespecting discount arrays? So you can see here we have this old market gap, right? So if you take it all the way out to the right, we only traded into a portion of that range. So I talked about this weeks ago or days ago that would be a level where price would want to return back up into and then continue the overall downtrend, right? But again, because we expect that, right, does not mean we just go into price action expecting market just to trade up into that and then sell off from there. All right, there's a lot of context. There's a lot of narratives that would need to read into price action, right? But the major takeaway, there are a lot of takeaways from this video here, but the main thing I wanted to focus on just a bit, because we are currently on our model, we're talking about long-term target objectives, how to go in and out of high time from order flow, when not to do anything. And you can see here that this low, this FOMC low from 17th of September, right? That's an intermediate term liquidity objective, right? So this is where everything starts to get really, really low probability because in the lead up to the sweep on this also liquidity, it is really easy to predict or anticipate how the market should deliver, right? We know the general liquidity. So we know that we're either looking for retracements into fair value objectives or we're looking for stop run. So whenever we see a retracement, that's a short opportunity. If that retracement fails, then we expect a stop run to be rejected aggressively. So we don't necessarily need to go and short above daily highs. We can go and anticipate that sweep on buy sell liquidity, wait for confirmation, which would be change in state of delivery, and that's your low risk, high probability entry to go and align yourself with higher time from order flow. So it is really straightforward to align yourself with order flow when there is a clear short-term drawn liquidity, and there is also a clear near-term drawn liquidity, right? So which is what we had here. This is where it starts to become a bit tricky, because we expect that the profile, remember there are 4 market profiles. We have consolidation, expansion, retracement, right? And reversal. When there is a clear order flow, when there is a clear general liquidity, what we anticipate is retracements and expansions. That's what we're looking for, right? Retracement and expansion. That's your focus. So every time we're always looking to constantly confirm, which is a lot easier, right? Retracements and expansions. But once the market reaches the near-term target general liquidity, the near-term objective, now the probabilities goes into all 4 market profiles. You could see possible reversal after the sweep and that liquidity. You could see a consolidation profile, extended consolidation profile. That's a thin, right? You could see, you can see in this example here, we run this daily out here, and what you get? You get a consolidation, extended consolidation, right? So it could be a consolidation profile. The market could just continue to blow right through the sell side liquidity and just continue to sell off. Or we could have a retracement and expansion. So you see here, there are so many factors to weigh in. There are so many things to factor in, which is why I've talked about your highest probability is when order flow is established. Your lowest probability is when order flow is not established, because the market has just traded into either a short-term general liquidity, which again, it's still easier to read. There's still protocols which we're going to discuss on the course, right? But when we get to near-term target objectives, that's when it starts to become tricky. Now, this is not the video to talk about near-term target objectives and why price action becomes a bit tricky around those levels. We will save that for chapter 3 of our course, 2026 course, right? But what I wanted to focus on here is confirmations. Now, the one thing I used to do way back when I started trading institutional trading was I used to because when I started off trading, I used to trade with trend lines and all the classic retail stick trend lines and candlestick confirmation, Mariposa candles, bullish engulfing, pin bars, all of that, Fibonacci retracement levels, right? Classic support resistance levels, all of those basic retail ideas. Again, I'm not trying to shit on any retail concept, all right? But then at the time where I started to, expose myself to the institutional side, or quote unquote institutional side of trading, and, start to look at price from the perspective of fair value and inefficiencies, right? And liquidity, I tended to just throw away all the things I took from my initial retail exposure, right? So when we talk about market confirmations, I'm like, who needs market confirmation when you know order flow and you know the direction that the market is going to? So that was the arrogance I used to have, where I felt like because I quote unquote knew how the banks traded, which was absolutely false, right? I felt like, I don't need confirmations. I could just go into the market, take my trades. And what happened here, which is, if you look at my tweets from today, right? So if you go on my profile on Twitter, right, and you look at my tweets from today, I was tweeting about when not to trade. So if we just scroll down just a bit, all right, which I do believe we should see Rosen here. I just wanted to show that tweet because I do think it is really important. So you can see here, there's a belief that the more trades you take, the more money you make. And this is one of the biggest trading myths, because the more you trade, what you're not factoring in is that every single time you go and place a trade, you're exposing yourself to risk. There's a mental stress. There's a mental fatigue that comes with trading. It is a reality. I know I preach, you want to be stoic. You don't want to give a fuck about the outcomes. Sorry for using the F word, but you don't want to give a shit about the outcomes of a trade. Your goal is to focus on the process, focus on executing the process, right? So that's what I preach. But you also have to factor in that we are humans. In as much as we try to be disciplined, discipline is willpower. That's what we're exercising when it comes to discipline, right? So there's something called fatigue. The more you go to the gym without resting properly, the more fatigued your muscles become, the less gains you're going to see at the gym. And that's the same thing with your equity portfolio and the amount of times you're exposing yourself to risk. There is a mental stress that comes with taking trades. There's all of the second guessing. There's all of the potential. Okay, what do I do? How do I navigate this, or how do I navigate to make sure that I do take the best decision on this individual trade? So imagine every time you try to expose yourself as frequently, which is why I really shame people who try to trade every single day, because every single time you're trying to expose yourself frequently and you're trying to take trades every single day, not just one trade, but actually multiple trades every single day, you're fatiguing yourself mentally. And typically what happens, which a lot of people don't factor in, is that mental fatigue leads to more lapses in judgment, number one, right? Number two, your willpower becomes lower because it's just fatigue. That's the way it goes, right? So once you have an outcome that does not really meet your expectation, so maybe you take a trade or you have like a losing streak, like 3 or 4 trades back to back, just all losses, and it does not meet your expectations, that then leads to a spiral. So what you've done is you've cultivated an environment to easily go into a spiral. That spiral is what leads to blown accounts. That spiral is what leads to all of those frustrations, and you lose profits, or maybe you're up in profit and you meet your daily drawdown just because you can stay out of taking trades, right? So this is where I like to preach that analysis is different from execution. It's okay to have all your drawers and liquidity and where you want to see the market go up or down into, but you have to create strict, high probability, low risk market environment in which you can only engage with that analysis. That is what separates an analysis from trading, right? So if we go and take a look at dollar, right, at the time where we were live streaming, and we're looking at lower prices on DXY. So if you go back and reference the recording on the live stream, I was talking about the fact that I like the market profile where we clear out the buy side liquidity up here on dollar, trade up into all of this inefficiency, and then we saw from there. But what was the problem with that information? Let me go back and use the replay tool because I think that kind of canceled just a bit. Let me go just back to at the time of our economic release. Okay. Now, what I was drawing your attention to at the time was, from a fundamental perspective, we had the play, or we kind of had because the trade is still currently on, but from a fundamental perspective, we had the play on dollar. And the play on dollar was that we wanted to see, initially at the start of the week, we wanted to see dollar sell off aggressively, and that was why we're leveraged short on USD CAD, so that aggressive sells. And I talked about seeing a bit of a recovery to potential reversal at this 4-hour bullish order block. So at the time of the economic release, I was saying to myself, okay, is this run higher? That initial expectation of wanting to see recovery from that 4-hour bullish order block, or is this a manipulation? Now, there are certain factors that made me believe this run, because I had 2 expectations. Either we reverse from here and we continue to trade higher, or, we see a bit of a retracement that took up buy side liquidity and we continue to oversell. So this is where, again, a lot of traders, when they create expectations in the marketplace, they only tend to look at one side. They would be like, oh, well, I am bearish, and so I will just continue to look for weakness in dollar. No, even though you're bearish overall, you create probabilities, and you use those confirmations to select what expectation you're going with, right? So you qualify. I have this expectation in price action or in this current data, but I also have a potentially opposite expectation. So how do I navigate with this information? Well, I create a list of parameters that I deem high probability. If this expectation is what I can see in the marketplace, I go and check those parameters, right? So if it aligns with those parameters, then that's something I'm trading. If it does not align with those parameters, then no trades for me, right? And you can also do this. It's not only about, looking at both sides of the marketplace. When you create expectations in price action, you also create expectation that invalidates your current expectation. So you need to know when you're going to get it wrong. I need to anticipate how you act should you get it wrong. Right, so that was what we had on dollar on today's live stream. We wanted to sell DXY, right? But at the time, we saw dollar expand higher. So the first thing I looked at was the data. What does the data signal? I don't know why this just keeps cutting off the. Not saving this replay. I don't understand why it keeps cutting off my replay. Like, what's going on? I think it resets after a while, kind of. Okay, so at the time when we looked at the data on dollar, data came out bullish, and I said to myself, when the data is bullish in an overall bearish order flow, which we had on DXY, that's why I went on the whole spiel about how to determine order flow, right? Retail will see the data and assume that dollar is bullish because that is being confirmed by the initial spike. So what do you think is going up here? There's a lot of retail buys up here. Now, I want to sell dollar just based off that narrative. But remember, just because I feel like DXY should sell off is not enough to take a trade. This is where we start to separate analysis from trades. So how can we define when to trade versus when not to trade? Well, the major things I look for is the risk lower? Meaning, if I go and take this trade, the factors that will cause this trade to potentially be wrong, are they lower, right? Are they reduced? That's number one, right? In terms of risk. The number two is, what are my market confirmations? I need clear confirmations that obviously tip the scales in one favor. Meaning, I will go into this market with the mindset of, let me try and qualify my expectation of wanting to be a short. And once I qualify that expectation of wanting to be a short, I am going to play devil's advocate. So meaning, if I want to sell, after I've done all my confirmations and I see that the market fits those confirmations, I then go and play devil's advocate, meaning, what would I do if I wanted to buy? That would give me insight as to maybe I am potentially reading the market wrong. Maybe there's something I've missed on the buy side that lowers the probabilities of shorts. Like, these are questions that you have to go through. These are mental frameworks that you have to go through. So at the time, we already had a confirmation that the data came out bullish on the XY, and we saw the initial spike. So now I am looking for weakness on dollar. But then we go and take a look at T-bonds at the time. Right, so you've looked at T-bonds at the time, which is, again, I made an exact comment on this on the live stream. I said I did not like the way we closed solidly bearish. If I wanted to see that run higher in dollar, be a manipulation, then looking at T-bonds, because again, what is the correlation between bonds and dollar, right? Treasuries and dollar. Treasuries is an inversion of yield or interest rate, right? So that means if bonds are bearish, interest rate is bullish. If interest rate is bullish, currency becomes bullish. What currency is associated with US government interest rate? The dollar. So that means dollar is bullish, right? So if I want to short dollar, I would not like to see this candle at 8:30, a solid bearish candle. I would rather have wanted to see wicks, we quickly run, take ourselves out liquidity, and we week back up. So I went over the three interest rate charts. So 30-year T-note, 10-year T-note, 5-year T-note, and I was looking at each candle, and I was making a comment during the live stream. I don't like the fact that we're seeing just extreme weakness on treasuries, and that is being confirmed by all or the other two interest rate chart. So this is 30-year T-note, this is 10-year T-note, same just aggressive solid closure. This is 5-year T-note, same aggressive solid closure. So that to me was feedback that, okay, if you want to short dollar, you don't want to see this kind of feedback on the bond market, on bond prices, and then we went and took a look at cable, right? So one of one of the cheat codes to determining high probability market environments, or after you've determined high probability market environments, you're trying to confirm one of the biggest cheat codes to trade confirmation, which a lot of people are not aware of. A lot of people like to use SMT profile and all of that, but the biggest cheat code to a trade confirmation is intermarket analysis confirmation. So that means if I want to short DXY, if I want to sell dollar, can I go and take a look at treasuries and see that treasuries wants to be bullish? Because there's a correlation between dollar and T bonds. If I want to short dollar, can I go and take a look at dollar yen, USDJPY? Can I go and take a look at USD CAD and see that they also want to be bullish, bearish? Your market profiles wants to be bearish. That's a high probability market environment. The more assets I could use to confirm an expectation, the greater the probability of that expectation. So at the time, we already had a bit of disparity between dollar and T notes because, again, I wasn't really satisfied with the way we closed on T notes on the lower time frame profiles, right? I was making a comment about the fact that if you take a look at T notes and you want to look at price from a bearish side, you can see here 30-year T note runs higher, 10-year T note, again, comparing the highs from last week Friday to today's highs, you can see 10-year T note also runs higher. And then if you go down to 5-year T note actually makes equal highs. And that was indicative of potentially low probability market profile. So what I told the guys to do is, in this situation, you sit out your analysis. Once you start to have doubts, once you start not to get the kind of confirmation you want, that's already low probability. But now here's a problem. A lot of people, they tend to focus on the now. They lose sight of the bigger picture. They tend to think, oh, if I don't take the trade now, I am going to potentially miss that trade, and I'm going to potentially get stopped out, or not stopped out. I'm going to potentially miss out on profits and maybe pass this funded accounts, or maybe use it to pay and da 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 da. And you fill your head with all of those thoughts. And what happens? You go back on the charts. You're trying to look for something. You're trying to convince yourself of something. And guess what? You take the trade because you just want to fulfill that dopamine response. So you take that trade. And the moment you take the trade, that FOMO feeling, it goes away. But what replaces the FOMO feeling? Fear. What if I rush the trade and the trade goes against me? Just how it goes. Like, that's how your brain works against you. So what I told the guys to do is close your charts, walk away. That's what you do. When the market does not meet that expectation, what you do? Close the charts, walk away, right? Come back a later time. Come back a different session. And that's what I told the guys we're going to do. So New York session is not offering what we want to see. Give it room. Give market time to do its thing. Give time to allow sentiment to settle in. Give time for the market to do whatever. And then we come back later and see if it does align. So here's what happened. So at the time, I sent out a trade on USD to sell short on the Discord. All right, so this is trading. And I said, I'm going to short USD, and this was my trade, or I took a sell on USD. My stop went above that immediate rebalance into that M15 candle, right? So, and we're looking at a swing target objective about a 4.2R, right? So at the time I went into the trade on USD, so we can go on a daily time frame profile. Already anticipated on USD was this balanced price range. So you can see here we have a balanced price range on USD. And then we go down to the M15 time frame profile. We've had a fair bit of response from our entry so far, which is slightly in profit. But again, you can see here, because of the multiple runs lower like this, all right, price might have a bit of difficulty. I'm trading through a sell side. Personally, I think that what we saw here was just a continuation of the overall bearish order flow. And our overall objective on USD was this weekly sell-side liquidity. Again, we already derived this from the start of the year. So from the start of the year, we already called that the near-term target objective on USD was down here. That's why if you go on my Twitter, you would see I have shorts in Yuzuka from here and from here and from here and from all the way up here, still holding swing positions from all the way up here, right? Just leveraging that order flow and just making fucking tons of money on these trades, right? So again, all I was looking for was just confirmation of probabilities. And that's the thing with established order flow. And that's what I talked about. Once you establish order flow and you also establish the draw or direction in the marketplace, it is really easy to flow in and out of trades. All you're looking for is identifying when the market is most likely to see a lot of volatility. All right. Just a tip. Typically, it is around economic releases during the week or days where we have economic releases during the week, right? So, around those days, the market is more likely to align. So the major question is, are we going to see distribution or are we going to see expansion? And that is all relative to your PDRA matrix, right? So your PDRA matrix is what gives you insight as to, are we potentially going to see distribution or are we potentially going to see an expansion, right? So again, looking at USD here, so at the time when we went in and took the sell, the confirmations I was looking for high probability shorts in DXY, they already were there. So first off, let's go back and take a look at T-bonds. If you remember, T-bond was my major gripe in terms of me not really satisfied with the confirmation I got on T-bonds. So at the time when I took the trade before this current candle, I don't know where this came out from, but you can see T-bonds were already recovering a bit fairly on 30-year T-notes, right? Let's go out to the 1 hour time frame profile so it's just a bit clearer. So on the 1 hour time frame profile, you can see that nice recovery in T-notes, all right? 30-year T-note, nice recovery. 10-year T-note, nice recovery. 5-year T-note, nice recovery. And if you look at the sweep on sell-side liquidity, 10-year T-note does not sweep sell-side liquidity. Again, I'm not trying to say here that we are for sure bullish. I really don't think so, because if you look at the overall structure on T-note, it is still a consolidation profile. That's what it is, right? So don't get me wrong. I'm not saying we're going to see T-note flip and go bullish from here. I'm also not saying T-note is going to flip and go bearish from here. I'm just saying that if I want to be short on DXY, I need to be able to see, or I need to be less certain of treasuries being bearish. At the time, I was really certain of treasuries being bearish just based off of what I was seeing in price action. Again, this is where the advice of trade what you see comes into play, right? Trade what you see. When what you see aligns with your expectation, you take the trade. When what you see does not align with your expectation, either don't take the trade or bail on the trade early, or don't even take positions whatsoever. So we saw a fair bit of recovery on T-notes. And once I saw that, I said to myself, okay, now I am starting to see that we are not as aggressively bearish as I thought we would be on T-note. So that means dollar can be allowed to slide lower. So if dollar can be allowed to slide lower, let me go and take a look at other assets. Let me go and take a look at cable. Can I make the case for potential bullishness in cable? All right, can I go and make the case for potential bullishness on euro? Yes. Clean eyes up here in euro, price trades down to a discount, clean buys. It's just clean longs on there in euro, right? So once I noticed that the roadblocks, all the factors that would lower the probability of dollar being bearish, once I noticed they were no longer present, that was when I could go and take the trade. That's why I talked about when you don't get the confirmations you want on the trade, wait until the next trading session. The next trading session usually should give you clarity. If you don't get clarity in the next trading session, the probabilities are still the same or similar. Just wait until the next trading day. That's how it goes. This is how you save yourself from trading in really shitty market conditions, right? So this is a really long video. I think it was probably about 28 minutes, almost half an hour. I hope you enjoyed the presentation. I'll see you in the next one. And in the meantime, peace. Trade safe.